Well, good morning, everyone. Thank you for joining. I'm just gonna let a few more people join. Wait a few more seconds here before we get our program started. But thank you for being on time. All right. Well, welcome to our RRC Mastermind 808 this month, featuring guest speaker Brian Ware. My name is Aaron Tangonan, and I'm the president-elect of the Hawaii RRC and will be your MC for today. I would like to first of all start with spotlighting our sponsor. We're always grateful for the generosity and support of Guaranteed Rate, who is sponsoring today's webinar. I'd like to welcome Anders Hostily to say a few words from Guaranteed Rate. Anders?
Hey, thanks, Aaron. Hey, thank you, everyone. And of course, I always thank everyone for the business and working hand in hand. Honolulu Association of Realtors, CRB, CRS, and we just always are very privileged and honored to be a sponsor. So again, thanks for the partnership, and yeah, I mean, stay tuned for a great presentation by Brian. Thank you.
All right. And, Anders and Guaranteed Rate have been supporting many of us for many, many years and many, many events. And we couldn't do a lot of this without their support. So thanks again to Anders and Guaranteed Rate. I'd like to touch on a few upcoming events before we get into today's presentation. We have a live event. It's called Year of the Dragon, Feast and Fortune. And it is to kick off the new year, which is the Year of the Dragon this year. On February 20th at 4:00 p.m. at Anaha and Ward Village, you'll have an option to reserve your space to get a feng shui reading by Clarence Lau, or just come and network with the rest of our RRC members and CRS designees. Just kind of get to know what we do and ask questions, but just a fun way to kick off the new year. So check the chat box. A registration link will be dropped there, and you can register for that. And it's coming up right around the corner, so don't miss out on that one. We have a few CRS courses. Actually, we have 5 this year, and our first one is scheduled for March 25th and 26th. It's titled Digital Marketing, Establishing a Social Media Brand. And this is our first course featuring social media expert Monia Nebauer. So you won't want to miss this one, and I'll be there as well. Our course registration link, again, will be dropped in the chat. So check that and don't wait. And next we have Pathways to CRS. So if you're thinking about obtaining your Certified Residential Specialist designation or need some clarification on the process, we're actually having a Pathways to CRS webinar discussing the whys and hows to get your CRS designation. It's a workshop where you'll hear about the process of obtaining the designation and the benefits of, and you'll have time to ask questions. So it's free. Again, the chat will have the link to register, so go ahead and do that. And speaking of CRS courses and the Pathway Workshop, for those of you out there that may know or may now know that there's a designation specifically for agents that do residential sales, it's called the Certified Residential Specialist Designation, or CRS. Only 3% of the nation's realtors have earned this designation, so take the courses and learn to boost your business. You can go to crs.com to learn a little bit more, or you can click on the link in the chat again and watch our Pathways to CRS video on the many benefits of earning this designation. And that link should be dropped in the chat shortly. And with that, I'd like to bring us to the meat of our meeting today. Before we introduce our speaker, I'd like to remind you that at the close of our Zoom meeting, an evaluation link will pop up. So please take a few minutes and let us know what you thought about our event so we can continue to bring relevant and timely information to all of you. Brian Ware is someone I know personally, great guy. He's a dedicated individual whose journey has been shaped by years of military service, academic achievements, and has a successful career in the mortgage industry. He's also getting a lot better in golf. He served in the Army and Army National Guard for 13 years, including deployments to Iraq and deployments to Iraq. He's a graduate of Texas A&M and holds a Bachelor's of Arts degree and an MBA in management. He's worked in the mortgage industry since 2009 with JP Morgan Chase and began working in both residential lending and commercial and industrial banking, and is currently the Senior Vice President and Residential Loan Sales Manager at Finance Factors. Brian is the President-elect of the Hawaii Association of Mortgage Brokers, and that's why he's here today. So without further ado, Brian, we'd love to hear your presentation and the information you got for us. Yeah, you're on mute, Brian.
There we go. Can you hear me now? All right. Thank you so much. Thank you, Aaron, for that great introduction. In case you all are wondering, yes, ChatGPT did write that about me, but it is all true. So just a little bit of forewarning. If you all are used to updates from Paul Brubaker and his style of talking and his type of pictographics and his very esoteric linear regressions and R-squared and all of that, I have a very different approach. I'm more of a common man. My graphics are going to be a little bit more easy to read. I hope that I'm not shooting under a little bit too much. So just bear with me today, guys. So here's my first graphic on the state of the mortgage industry. I went back and forth for a few different graphics, but this one pretty nailed it. What we've been going through for the last really 18 months. You got this guy, he's pretty beat up, obviously beat up, but he's trying to put that smile on his face, telling you everything's okay, giving you a thumbs up. But deep down inside, he's really struggling. These past 18 months have been very, very difficult for the mortgage industry. So, I'm sure you talk to your favorite loan officer and you ask him, hey, how's everything going? And he's like, oh man, staying busy. If he doesn't tell you particularly what he's staying busy on, just know that that's code work for, I'm struggling. We're struggling to find deals out here. But, still in our suit and tie, still in our finest Aloha attire, still putting in the hard work. We're hoping to see a silver lining in some of this information that I'll be sharing with you today. So let's take a little bit closer look into the numbers of why this has been such a tough time in the mortgage industry. So these numbers are specific to Hawaii closed loan count and volume over the past year since 2020. 2020, 2021 were absolute banner years for the mortgage industry, closing just in the state of Hawaii alone, $21 and $22 billion in lending. And as you can see, the majority of that was in refinance production. With interest rates as low as they were, you would have been not very intelligent to seize on the opportunity to lower your interest rate to 2.5%, 3%. So we were busy. We were so busy, we were batting off loans, and there was just some things that we couldn't do just from a capacity standpoint. There was a lot of movement in the industry when you're in this time of low interest rates. The employment competitiveness for operations partners to process and underwrite those loans are very difficult. Salaries jump through the roof. People are switching left and right. And I'm sure many of you kind of saw that pressure, with your purchase contracts during those years, because not only were there upselling and, $20,000, $50,000 over asking price, but they were asking to close quickly. And, mortgage companies, we were struggling to manage that capacity. Right around the summer of 2021, that's when interest rates started to rise heavily. And we really see that, 2022, we see that really heavily reflected. There was a 50% drop off in volume through 2022, and then that halved again in 2023. So, between 21 and 23, that's only 2 years, there's roughly a 300% drop in production. So there was a lot of layoffs. There was a lot of, loan officers who got out of the industry because of the lack of volume. There was a lot of compression in the market. And we'll take a look at some of the things that happened on that. So just a quick graphic of, the timing of that. As we see the summer of 2021, interest rates just skyrocketed through the roof, reaching upwards in the capacity of 8% at some points. And we still haven't seen much relief for that, but we are hoping to see, fingers crossed, some of that happening in 2024. Some of the major events that happened because of that were some significant bank failures. So 3 very significant banks, 1 out of New York, 2 out of California, total assets over 500 billion. Those banks failed. Part of that was due to the high rate environment, the rising rate environment. Some of it was due to concentration in certain asset classes. But there was just a lot that happened last year in the financial industry as a whole that caused some very negative things to happen. And if you take a look at this next slide, obviously you cannot read this list. I just put it up there so we can see the sheer volume of the negative things that happen. This list is just mortgage industry companies that had closures, layoffs, were acquired, or exited the mortgage market just from 2022. So all of this has happened in really the last 18 months. I know you're familiar with, some of the bigger names, Loan Depot, Wells Fargo suspending their correspondent lending program. But this is just a list of major companies across the nation that had some, very negative aspects from that since 2022. And I know this looks like a long list, but for those of us who have been around the mortgage industry, for longer than a few years, this is not surprising. The mortgage industry, and very similar to the real estate industry, we work in cycles, and we work in environments where it's feast or famine, and it's hard to mitigate the famine when you're in a feast mode because you need to do those additional capital expenditures. You need to grow to be able to manage the capacity of the additional loan volume that's coming in, and then when that famine hits, and we never really know when that's going to hit, these companies become overinflated, and they're not able to manage all of that operational expenditure that they were putting out without the consistent volume that's coming in. And it's just a very difficult thing to manage. I remember, with my first career, when I started at JP Morgan Chase, I was in the Washington, D.C., Maryland area. And at the time, when I started in Texas, I was at a bank branch. And then when I moved out to the D.C. area, there were no JP Morgan Chase bank branches there at the time. And I, just finished closing a loan out in DC. So I went over to, our downtown DC office, and I'm sitting there, plugging away, working on my files. And MSNBC is on the TV, and our CEO, Jamie Dimon, is talking about the mortgage industry. So I was like, oh, let me stop here and see what our fearless leader has to say. And he said, and I'm paraphrasing, but basically said, I don't really care for the mortgage industry. And if it wasn't a necessary need for my bank branch clients, I wouldn't be in the industry, and I really prefer only to lend, to the clients that work with bank with us. And I'm sitting in DC where there are no Chase Bank branches. And I kind of look around to a couple of my peers, and we kind of all have that same look on our face, like, I don't know where this is going. 3 weeks later, they fired half of our management staff. They closed down an operations center. And with 6 months, all of the Chase branches or mortgage banks branches in that area were closed down. So we're really used to this in the mortgage industry. It's something that we recognize when, after spending, a year or two in the industry, we recognize that it's going to come with this type of battle. But we do it anyways because this is what we love. This is our passion, and it can be a very, very rewarding career. So, all of that negative news, it's going to impact the way that the lenders respond. It's going to impact, the way that we operate and we look at different loans. And part of that is going to be a tightening of credit policy. We're really really need to be asset protective at this point. Because of the chance of, additional compression and the lack of additional revenue that we were used to seeing for the last couple of years. And then, as there's concerns, as we, hopefully start to lower the Fed funds rate, there's still a fear of recession. So there has to be some protective measures taken on our asset capital class. So there's going to be a less risk appetite for certain types of collateral. I know here in the state of Hawaii, the land loan program was very effective. Most of the major lenders either backed away from or just discontinued their land loan programs completely. Resort zone has been something that we consistently look at because in the time of recession, we take a look at asset classes that are the easiest to walk away from a borrower, and that's obviously vacant land is the first thing. There's no true intrinsic value to just land that's raw. Resort zone, vacation type of rentals, those, if they're not producing well, they tend to be the easier things to walk away from. So that comes with an increased level of scrutiny of those types of lendings and the type of borrowers that we feel comfortable with giving those types of loans to. We want to make sure that they're very solid borrowers and that they can stand a downturn in the market if there isn't consistent income coming through from those investment properties. So of course that just lends to more competitive pressure on your A papers type stuff, your Fannie, your Freddie, your owner occupant, even in your higher jumbo spaces, the $2-3 million single family market. You're going to see a lot more competition and rate compression and competitive pricing, competitive underwriting around those types of products because they tend to be more stable in the downturn of a market. Something else I want just to mention so that everybody's really keeping an eye on is the commercial real estate space. Right now we're in I don't believe we've really truly seen the effects of the bubble that the commercial real estate space is in. Commercial real estate operates a little bit different than residential. Usually residential, you're looking at 15 to 30 year fixed amortized loans. Commercial real estate loans, they tend to balloon at 5, 7, 10 years, even if they're amortized over 20, 25 years. So, with COVID and the work from home environment, a lot of people never return to the office. Well, if you don't have anybody working in your office, you're probably going to end your lease when you can't. That's going to drastically affect the rent rolls of these commercial investors when they come time for them to refinance at their balloon time. They're not going to be able to show the similar rent rolls that they were showing before COVID. We're in a much higher interest rate environment than we were then. So there's going to be some drastic affordability issues. Banks may be looking at some very catastrophic losses if they are highly concentrated in the commercial real estate space. Even though that's not residential, it's going to affect the residential market because if banks, have a huge hit to their liquidity, huge hit to their asset class, they're not going to be able to take some of the more, riskier investor type loans and their portfolio loans. So there's going to be a compression on that, and it could also affect the rate environment. But there's good news. So, it's not just all bad news. Employment rate is at a 50-year low at 3.7%. Inflation is down from 9% to 3%. The target is 2%. If you guys aren't nerds like me and didn't watch the, Jerome Powell interview that he did, he's not going to be waiting until the 2% target to lower the interest rate, to lower the Fed overnight rate. As you see in my last bullet point, there is an expectation that that's going to happen at least 3 times this year, beginning over the summer. There's less fear of recession. It's not gone. It's not completely gone. We still have to, hit this quote unquote soft landing that everybody is looking for. But the stock market is doing fairly well. There is some compression on the interest rates. So there really is some good news. There's a lot to be optimistic about. Of course, for every optimistic, thought out there, there's someone on the opposite end of the coin, causing for doom and gloom and, a massive reduction in the stock market. But at the same time, at the end of the day, we really don't know. But my personal hope is that we are at the other end of these tough times, and we will find some more stability. Now, will we see those 3% 30-year fixed again? I highly doubt it. That's going to come with some really bad news for the rest of the world, I would imagine. So I wouldn't even hope to see rates hit that within the next 3 years. To be honest with you, I think a good target is around, 5.5%. So what does that mean for mortgage rates? That good news. There's two reasons why I put this picture up. One is I'm never going to pass on an opportunity to show you guys what kind of a Renaissance man I am, a high culinary talent that I have. That's me making sausages. But more importantly, it's a good metaphor for what goes into mortgage rates. I get a lot of questions, from my realtor partners, my broker partners. It's really more of a statement. Hey, I hear the Fed's going to drop interest rates this year. Well, that doesn't mean that mortgage rates are going to drop. It's the Fed overnight funds rate is the rate that banks use to borrow money to fund their different loans. So it is an ingredient in the sausage that makes mortgage rates, but I would say it is not even the most important ingredient that goes into what's going to be happening with mortgage rates. As I pulled this survey on February 2nd. And I did a survey from the last time the Fed dropped rates. So the last time the Fed increased rates. So they increased rates in July 26th last year. Interest rates were sitting, right around 6.5% to 7%. And over that course of a time, we had a 1.5% swing all the way up to 8%, back down to 6.5%. Now we're creeping up a little bit closer to 7% again. But that all happened without any Fed intervention, any movement of the Fed overnight fund rate. So there's a lot more that goes into interest rates just other than just the Fed overnight rate. So here are some things that can affect, mortgage rates, really overall economic growth and world stability. In the mortgage industry, we have to be a little bit pessimistic if we want to see interest rates go down. It usually happens when there is negative economic news. So, as you see, the lowest interest rates that we've seen, in my time in the industry was right smack dab in the middle of the worst pandemic the world has seen in my lifetime. So that's obviously not good news for the rest of the world, but it was unfortunately phenomenal news for the mortgage industry because we were able to do a lot of production during that time. Right now there's a lot of things that are happening in the world that I would, really keep an eye on as far as how that affects interest rates, mainly, the conflicts that we're seeing and the potential escalation of different conflicts. There's some Russian aggression, obviously, in the Ukraine front. There's escalated talks now, about their feelings towards us here in America. North Korea is really kind of ramping up their tensions with South Korea. Of course, the Gaza issue, all of these things, can affect the overall health of the market, supply chains, things of that nature, which can cause a compression in the mortgage rates. Obviously, inflation plays a big part in it. One of the things that I always look to the most when I'm looking to gauge, interest rate movement within the week is the 10-year Treasury bond, the bond market, but especially the 10-year Treasury bond. Investors on Wall Street view that as a competing good. So when there's good news in the bond market, it usually means bad news for the mortgage market, and then vice versa. So that's one of the key kind of reverse indexes that I look to gauge what mortgage rates are going to be doing. Then of course, bank capital reserves. We talked about how the commercial bubble could drastically affect that, and have a shift of where we view revenue. And what steps we have to take to continue to increase our revenue in difficult times. And then, of course, housing market conditions and inventory play a large part in the interest rate environment as well. So this is just a quick shot to show you, the difference, that really we cannot predict where interest rates are going. So Fannie Mae and the Mortgage Bankers Association, MBA, they have very different views of where they see interest rates going. Fannie Mae and MBA, looking into 24 and 2025, they're about 1.5% apart. It's a pretty big variance. And at the end of the day, if someone is going to guarantee you that interest rates are going to move in a particular direction, they either have a magic crystal ball that none of us else have, or they're just, flat out they're just flat out lying. Because the truth is nobody knows. We do our best to guess. We do our best to be optimistic. and everybody has their different ways of reading the tea leaves, and it's open to interpretation. But at the end of the day, we really cannot tell you that information because we really do not know, because we can't see around the corner. We don't know if there's another pandemic waiting around the corner. We don't know if there's a huge war waiting around the corner. We don't know if there's phenomenal news that's waiting around the corner that's going to just grant wonderful market stability with lower interest rates. And especially now you're looking at a presidential cycle, it's always going to be different. There's always going to be increased scrutiny on what's happening in the market. There's going to be some political plays that make it look, as if things are better, or maybe look at as worse, to sway, your opinion on who you're going to be voting for. So this is going to be an even much more difficult to try to predict that type of environment. So, that really concludes my my update on the mortgage industry. The hope, the desire is that we will see some interest rate compression. We'll see some some drops in the mortgage interest rates, but there are some things that we are eyeballing, just in case that we do not see the market move in the way that we're hoping to do. So next, I was asked to give you a lender perspective on the underinsured condo situation. So the basic of it, and I want to be very crystal clear, the official Freddie and Fannie stance is that condos must have 100% replacement coverage for all catastrophic events, including wind, fire, water, and when water includes hurricane. So that is the official update. That is the official stance of Freddie and Fannie. Obviously, the majority of the local lenders, we've decided not to assume that level of risk and continue to sell to Fannie and Freddie. There are some lenders who are still continuing to do so. I'm not here to make a judgment call or say anything of it. I just want to kind of explain a little bit of what goes into that, and that risk assumption is that when you sell to Fannie or to Freddie and you're direct seller, you package all of your loans at the end of the month. You send them over to them, you sell them in that package, and then they decide to audit however many they want to. So if you send over 100 loans, I can't tell you the amount of audit, but let's say they pull 4 loans. If you're a local lender and you do the majority of your lending here locally, the likelihood, if you're continuing to do condos underinsured as is, the likelihood of one of those files being pulled for audit is a little bit higher than if you're a national lender, and you're sending in a much larger package with a much more diverse geographical representation of loans. And Hawaii is such a small market to these national lenders. The risk is just being currently assumed, and they're continuing to sell these to Fannie and Freddie. There are some lenders who are offering portfolio solutions as well. Again, I'm not making a judgment call, but I don't believe it's a long-term fix. And there are some things that we are working on in that arena to find a tangible long-term solution to this underinsured condo issue. Part of that is ongoing conversations with Freddie and Fannie. Part of my career, I worked for Capital One Bank, and the management team left to go over and lead the affordable housing division at Freddie Mac. So fortunately, I do have some good connections there. We've had a couple of conversations about the issue. I'm hoping to put a panel together to have further conversations with them, with local lenders, to find a true solution on that. And then, of course, there is continued legislation and advocacy on part of us at HAMB, as well as MBAH, as well as HBR. I've seen some of the comments and testimony that you guys have provided to some of the bills there. I do recommend, if you do at RCC have a legislative arm that you look, or if you're familiar with HBR's legislative arm, that you assist with doing whatever you can to look at HB 2056. It talks about finding an exploratory committee to fix this issue. So this is the last update I did receive from Freddie Mac, or everybody received from Freddie Mac, who subscribes to their bulletins. There has been some updates on condominium association coverage. And I'm not going to spend the time to read this. we will be providing our PowerPoint slides and my contact information. So if you want me to forward you the entire bulletin, I have no problem doing that. But I will highlight what this says. They are Freddie Mac, and I believe they said that Fannie was doing the same thing. They are putting a cap on the deductible for catastrophic events. They're still requiring full replacement cost at 100%, but they are putting a cap of 5%. And then if the deductible is higher than 5%, then they are allowing HO6 coverage, so that's individual unit coverage, to make up for that portion of the 5% deductible, to provide coverage that will bring that deductible down to 5% of the unit. So this is a step in the right direction. There still needs to be some things that happen for us to have a permanent long-term solution. I mean, first and foremost, we have to be able to raise the coverage to 100%, but maybe because the allowance to raise the deductible to higher than 5% could lower overall premiums, and then we can find an HO6 coverage to make up for that gap. But currently, as far as I know, there is not an HO6 policy that currently speaks to that language to making up that gap. But again, I am not an insurance expert. I only know that, based on some of the things that I've seen in that area. So like I said, it is good news. It's a step in the right direction, but I think, between the legislation, between the ongoing conversations, it may be quite some time till we find a true permanent solution to this very particular issue. And there's, and this is just the forefront issue on everybody's mind of what's going on in condo land. I do recommend, if you guys already haven't had Sue Savio come and speak to your group, she's a wealth of knowledge and a straight shooter, and she'd be more than willing to talk to you guys about some of the other issues, as well as this issue that's affecting, condo land right now. So lastly, I was asked to, just give you a brief overview of some unique lending programs that, you can take advantage of with your buyers, or, let your sellers know, or possibilities for their sale. So I'm obviously not the sponsor today. So I just want to give you an overview of what is available entirely out in the market. I know Anders and his team well. He has access to all, if not, most, if not all of these products we'll talk about here today. So I just want to give you a couple tools that you can use in your tool set. So when you think unique lending programs, Fannie and Freddie probably isn't your first of mind when it comes to unique lending, but once your borrower reaches the age of retirement, they do have a couple of programs that you can use asset-based lending instead of going off of their income. So one of those is asset depletion, and this can be used in a situation where your borrower is of retirement age, but is still working, and they're not taking retirement distributions yet. What Freddie does, or Freddie and Fannie both do, is they take 70% of the value of their investment accounts and their retirement accounts, divide it by 20 years, and that becomes or divide it by 240, right? 240 months. That becomes the monthly income that they can add to your borrower's income for qualification purposes. Now, if your borrower is retiring or retired and they're taking distributions, all they need to show is that those distributions will continue for 3 years. And they would use that income to qualify for their loan. Where they got 3 years, I'm not entirely sure. I guess they figured after 3 years you run out of money, you can do a reverse mortgage and maintain the house. But to me, it's a very liberal way of calculating income. Some other programs that are out there that I recently seen is an asset-only program. It seems to be very simple. If you're looking to borrow $500,000 and you got $500,000 in the bank, that's all you need. I thought that was a really fantastic program that I've seen. I know a couple of lenders that are offering that. Of course, bank statement loans. These are really best used for your self-employed borrowers who are practicing a really strong tax avoidance policy. So they're writing off a lot on their income, and us lenders cannot use their tax returns to calculate the income that they need to buy the home. So this is really more of a cash flow loan. They'll look at 12 to 24 months of bank statements. They'll add an expense ratio And then they'll use whatever they see in deposits, subtract that expense ratio, and then that's the income that they will use for qualifying the loan, which is usually a lot more favorable than some of your self-employed borrowers are showing on their tax returns. DSCR loans, if you guys aren't familiar with those loans, it's an investor-only product. It is designed to be a cash flow based on the property itself. So in this rising, this high interest rate environment, these have been a little bit more difficult to get through. You have to really have a pretty low LTV to get a DSCR program in right now, just because of the high interest rate. So, but basically, this program is, it looks at the expected monthly rentals received from a property. If it's higher than the expected monthly payment for the loan, then that loan will be approved. Again, there's for investors, there's still a stated program out there where you just tell us how much you make. We may do some verification based on your assets to make sure that's in line, with what you're saying, but there's still some stated products out there for investors. And then of course, multi-collateral lending, which allows you to use more than one property to make up the LTV required for an acquisition. So, examples of the way that's used is, investors who have a lot of properties, some decent equity, they don't want to touch their first mortgage, they don't want to get a second mortgage. They can combine the equity within those properties to meet the LTV requirement for new acquisition up to and even more than 100% of the purchase price, as long as they can income qualify. And then, of course, parents, grandparents who want to help, their kids buy their first home that don't have a lot of cash. This is a way that you can manage that without actually having any cash transactions, any cash changing hands. So, and I know for a fact that Anders and his team over at Guaranteed Rate have access to this program and many of the others. So, that really concludes my presentation. The last thing that I will say, as President-elect of Hamby and chair of the membership committee, we would love to see some more involvement with the real estate community. We would love to invite you all to become affiliate members of our organization. We do a lot of great educational training. We actually did just have Sue Savio last month to give us an insurance update. We've got some really great education and networking seminars coming out here within this year. And of course, we have our monthly golf tournament, which I see Aaron mentioned, and I appreciate you saying my game is improving, but it's still terrible. So that is the end of my presentation. I hope you all, received some knowledge that's usable for you. But at this time, I'd like to open up the floor for questions if there are any questions for me.
All right, Brian, we do have a question here. Let's see. Brian, you mentioned an overall tightening of credit policy, and it seems to me, the person asking the question, that the increased activity with the asset/bank statement-based lending programs, there's increased activity with that. Do you see any dichotomy in this?
No, because we're still underwriting to cash flow on that. So even though we're looking at cash flow differently, doesn't mean that we're accepting less cash flow or we're accepting less FICO scores. The tightening that you're going to see, is the way that we review your credit, your history, your timely mortgage payments, and really taking a deep dive into your cash flow to see if there's some stability around that and there's wherewithal to go through a downturn in the market. So just because we're getting a little bit more creative and we're allowing for more ways to view income, doesn't mean that we're not taking a closer look on the stability of that income, and the projected use and how that's going to affect, you being able to hold on to that property in the long term.
All right, second question. For foreign investors, this agent in particular has many Japanese investors. They would like to know if bank statement loans can be used for them because it is difficult sometimes to get a regular loan program due to the lack of a FICO score and other requirements. that something that's possible?
There may be some programs out there available for foreign investors using a different type of income. But I'll tell you right now, that's always going to be a little bit more difficult because foreign investors are always considered a little bit more of a riskier borrowing class. So as of right now, I'm not aware of anyone that is offering that product. But that doesn't mean that they're not. But right now, I'm not aware of anybody offering that product right now.
Well, those are the only two questions so far. If anybody else has any questions, please type them in the Q&A box for a few minutes. Otherwise, we'd like to thank you, Brian. That was very, very informational. Hang on one second. Yes, we will have a copy of the presentation to share, and Brian will be sharing his slides with us, and we'll distribute it to all the attendees. There's a question about hurricane insurance for condos in Ward Village, but doesn't give a specific question. So if you'd like to type your question again and ask specifically what you'd like to know about hurricane insurance coverage for condos in Ward Village, I don't know if we can answer that. But yes, in addition to HAMBI's many educational seminars that they do throughout the year, and HAMBI again stands for the Hawaii Association of Mortgage Brokers. There's also a Mortgage Bankers Association of Hawaii. But HAMBI does a monthly golf tournament. So all you golfers out there that like to network with loan officers, that is a perfect way to get a chance to meet them in person and ask questions. We do get a lot of different variety of mortgage broker and banker people in those golf tournaments, and it's just a fun way to spend a day. So if you'd like to join them, ask Brian or ask me. I'll put you in touch with that golf specific membership. Okay, so here's the question. Are buyers limited to be cash buyers due to hurricane insurance issues with condos in Ward Village, but maybe specifically with other condos which may have the same issue as well? So if they're not able to get lending, I suppose.
Yeah, and I touched on that. There are lenders, who are still doing lending there. You know, so there definitely are lenders that are still lending in there. I touched on the fact that Fannie and Freddie, they do require 100% replacement coverage, but there are different risk assessments that are being done at each individual lender, especially the mainland lenders. So reach out to your favorite broker, guaranteed rate. Anders would, I'm sure, put you in touch with somebody who can find a lender or find a program that can continue to do so. But it's it is there is some risk involved. There may be additional underwriting requirements, but if not, then yeah, unfortunately, cash seems to be the alternative.
And the exact issue is the next question, but we did cover that in the presentation. We'll give you the slides and probably a recording of the presentation today so that you can watch it again at your convenience and can go over the information. And let's ask Wendy to put Brian's contact information in the chat so that he can answer any questions that might pop up afterwards.
We'll include it in the email that we send out.
Okay, perfect. And I have a question on the legislation. I mean, what do you think? How? I mean, I know it'll be a longer term conversation with legislation and trying to get assistance with the government, but how receptive have they been in those conversations and in helping or addressing our issues?
So currently the bill has passed committee with some amendments. It was scheduled to be here it's gotta go through two committees, Fin and CPC. So Finance and Consumer Protection Committee. So it's cleared Finance Committee with some amendments. It was scheduled, I believe, last week for Consumer Protection Committee. There's been some good testimony from HBR. We're going to be providing additional commentary for the next committee hearing and the floor reading. But there's been some really negative feedback from the reinsurers and the insurance community. So, I think this is going to be a close one. And the more that we get involved, and join our forces to provide comment for this bill, the better chance that we have. So I would right now put it at a 50-50.
Okay, cool. Well, something to watch for sure. And I'm sure also the Hawaii Association, which is the association for the whole state, is also monitoring that as well. They have a governance committee that takes a look, and they do have ways to lobby as well. So I'm sure it's a statewide movement since it affects everyone.
Indeed.
We'll keep a close eye. All right, there are no other questions. We'd like to thank Brian again and the Hawaii Association of Mortgage Brokers. And again, our sponsor, Guaranteed Rate and Anders Hosteli. Thank you for always continuing to sponsor our events and giving us updates as well at each of those events on what's happening in the industry and other ways our buyers can be protected and have access to continual lending programs to continue to move our market forward and give our sellers reassurance that buyers can continue to buy the properties they're selling. So if there are no other questions, again, thank you all for coming in today to watch our presentation. Please do take a moment to answer the questionnaire for the evaluation on today's program so that we can continue to bring more timely and accurate information to you all. So stay tuned for that as we end the broadcast here. But thank you again. Enjoy the rest of your week and join us if you can at the Chinese New Year event on February 20th. I look forward to seeing more people out there in person. Have a wonderful day, guys. Thank you all very much.
Thank you, everyone.